On September 7th, the spread between 2-year and 10-year U.S. Treasury yields traded a monthly high near negative 13 basis points. Now, it was only days later that the latest read in CPI changed market sentiment, and Fed funds futures went from pricing in a terminal Fed funds rate of 3.5 to 3.75% to pricing in 4.5 to 4.75%. Now, as expected, the yield curve deepened its inversion quickly, as the expectations were for an aggressive Fed move that could risk over-tightening financial conditions, even with the possibility of recession, in order to tame runaway inflation, with 2s to 10s trading down then to a low of negative 57 basis points on September 22nd. Now, historically, an inverted yield curve is a harbinger of a coming recession, and many feel that this time is no different. Interestingly, though, a heavily inverted curve is generally not related to the severity of the coming recession, but it is associated with how quickly that recession may arrive. Some argue that we're already in a recession, as the last 2 quarters have printed negative GDP growth and expectations for the next read on GDP have been coming down. Additionally, in recent weeks, the Fed has stepped up its quantitative tightening program, which could elevate long-end rates. Now, if a trader believes that the yield curve could further invert from here, perhaps on Fed rhetoric that may suggest more aggressive short-end hikes, they could express that by buying the September CME micro 2-year Treasury yield futures contract at 4.27 and selling the September micro 10-year Treasury yield futures contract at 3.86. Now, this represents selling the 2s versus 10s spread at negative 41. A target for this trade could be negative 80, and a stop could be placed above at negative 15. This trade could make $390 if your target is reached and risks $260 if you're stopped out of your level. There are 2 things to remember when using 2 assets in a trade. You need to closely monitor the trades to manually stop yourself out or take profit. Also, trader will need to roll into the October contract by the end of September to keep this position on. Now, if a trader believes that the curve could head back towards 0, they could express that by selling the micro SEP 2-year Treasury yield futures contract at 4.27 and then buying the September 10-year Treasury yield futures contract at 3.86. This would be buying the spread at negative 41. A target for this trade could be back to the psychological level of 0, and a stop could be placed below at negative 70. This trade could make $410 if the target is reached and risks $290 if you're stopped out of your level.